Hello and welcome to the look ahead for Thursday, the 7th of December, with me, Fiona Cincotta, Senior Market Analyst at City Index. So the earnings calendar is a little bit busier than it has been for some time. We've got Broadcom, Lululemon, DocuSign, and Dollar General all updating the market with their earnings tomorrow. On the economic calendar, first up, we have the Chinese trade balance. So in focus here will be the exports, which are expected to fall 1.1% after falling 6.4% previously, and imports, which are expected to rise 3.3% after rising 3% previously. Now, just with regards to China, there's obviously been some concerns over the health of the economy there. We had Moody's earlier in the week downgrading the credit outlook for China. We've also had PMI data, which has painted a very mixed picture, with manufacturing showing signs of weakness. Now, when we're sort of thinking about China, the FTSE is a good opportunity to take a look at the FTSE. If we think about those miners on the FTSE, the heavy-weighted miners, can be quite an influence on the index. Now, interestingly, though, we can see that the FTSE has in fact been pushing higher in line with its European peers. We had the DAX hit a fresh all-time high today, and obviously with the rally that's going on in the US. So, sentiment is broadly upbeat, though, as far as the European indices and US indices are concerned. FTSE is lagging behind still, but it has pushed over, it's recovered from support, the 20 SMA earlier this week. It's pushed over the 100 SMA. And as you can see, the next hurdle for the index will be that 200 SMA that we can see there. That's around the level of 75.75. Now, if on the downside, support can be seen at around the 74.60 level. That was 20 SMA and also the weekly low. Also, whilst we're thinking about China, be a good opportunity to take a look at what's going on in oil prices. Obviously, China being the world's largest importer of oil. So weakness in the Chinese economy can be reflected in weaker oil prices. And we certainly are seeing weaker oil prices, although I think this is actually more to do with a story, or it's also to do with a story on OPEC plus, who, with their voluntary output cuts, and that word voluntary has unnerved the oil market, thinking that perhaps actually these 2.2 million barrels per day of output cuts won't actually materialize. So again, with oil, crude oil, it's trading down 4% today. I mean, it's down for a fifth straight day. It's trading at a 5-month low. It's pushing below that key $70 the barrel psychological level, and the next stop could be $67 the barrel. That's the lows that we saw back in June. So just as far as any upside recovery is needed there, I think we need to get back above the $70 mark in order to push back towards that 72.50, 72.70 level, which was the previous low in November. Just what else we'll be watching, as well as Chinese trade data, we've got Eurozone GDP figures. This is not the third estimate or third reading, expected to confirm that 0.1% contraction after a 1% rise in the second quarter. I think it's interesting. I mean, obviously Q3 GDP data now does feel a little bit stale. I think a big revision, especially a big downward revision, could impact the euro quite strongly. But otherwise, I think it's time to be thinking about what's going on in the current quarter. And we've seen PMI data, the final reading for November, come out this week for the services and the composite readings. They were slightly better than expected. They were upwardly revised, but remain below that key 50 level, which separates expansion from contraction, suggesting that we're set to see another contraction expected in this quarter, in the current quarter. Although the fact that we're seeing stronger than expected PMIs albeit below 50, does suggest that maybe any recession could be weaker than initially expected. Now, the euro has been coming off really quite strongly in the past week. Over this week, we had ECB known hawk Isabel Schnabel saying that, in her opinion, the ECB is done hiking interest rates, given that inflation has cooled so significantly. So inflation in the Eurozone down at 2.4%, just above the ECB's 2% target. Obviously, if that goes with contracting, the economy contracting, does mean that there is really little chance that the ECB is going to be hiking interest rates again. So the focus is, when are they going to start cutting? The market's currently pricing in a full rate cut in April and around 125 basis points worth of cuts next year. So yeah, that's been weighing on the euro, which briefly pushed over that 110 level in November and has since fallen pretty firmly lower. It's taken out the 200 SMA there at 108.20. It's testing at the moment the 100 SMA at 107.70. Now, if we do see a fall below that, I think that's going to bring in the 107.50 level, which, I mean, if we're looking for any recovery, if we're finding that 100 SMA does hold, then obviously that 200 SMA at the 108.20 is going to be a key level for buyers to get back over in order to bring 108.50 into the equation. And just finally, also, we've got US jobless claims. Jobs has been a big focus in the markets this week. We've had jobs openings, we've had ADP payrolls, and tomorrow, we're going to be having US jobless claims. So far, the job openings have come in at a 2-year low. We saw the ADP private payrolls come in unexpectedly lower at 103,000, down from 113,000, well below expectations of 130,000. So the data is pointing to weakness appearing in the US labor market. Will jobless claims continue to show this? I think jobless claims, the initial claims are expected to tick higher to 222,000. Ones that I've been watching more closely recently is the continuous claims, and these have been slowly climbing higher. They got to 1,927,000 in last week, and they're expected just to ease very slightly this week, but still the trend appears to be climbing high, which suggests that Americans that are out of work are finding it harder to find work, which again points to more weakness in the US labor market. Now, a weaker labor market really does support that narrative of the dovish pivot from the Federal Reserve. Again, I mean, we've got the FOMC meeting next week. The focus is, no more rate hikes are expected from the Fed. The focus is, when will the Fed start to cut rates? And it's going to be an interesting one because, I mean, obviously the Fed don't want to start loosening monetary policy or hinting towards loosening monetary policy without being absolutely certain that inflation is heading back to target of 2%. But at the same time, the market's trying to second guess the Fed. And it's doing so at the moment by focusing on data because we're in the Fed blackout period. So, and as we're seeing, when we're getting those weaker readings come through, that has been just helping the US indices grind that bit higher. After a really strong rally across November, we've seen the rally has been losing a little bit of momentum. It's very much grinding higher after pushing above the 45.40 level, grinding towards 4600. That's the July high. If we get a move above there, we'll be looking to the 46.35. That's the March 22 high. As far as support is concerned, I'll be looking at support around the 45.40 level, and a break through there brings the 4500 round number into focus. So I hope you have enjoyed this today. If you have, then please remember to press the like button and do subscribe if you would like more videos like these. Have a good evening.